September 15, 2008. In a single, frantic trading session, Freddie Mac's stock plummeted more than 70%, and the government seized the mortgage giant, sending shockwaves through the global financial system. The government-sponsored enterprise that once promised to stabilize America's housing market became the very catalyst that nearly bankrupted the nation. Founded in 1970 as the Federal Home Loan Mortgage Corporation, Freddie Mac was born out of a simple, optimistic premise: create a secondary market for mortgages, free up lenders, and make homeownership accessible to millions of Americans. By buying mortgages from banks, bundling them into securities, and selling those securities to investors, Freddie Mac injected liquidity into the housing sector. Over the next 3 decades, its balance sheet ballooned from a modest $30 billion to more than $1.6 trillion, making it one of the world's largest holders of mortgage debt. The rise of Freddie Mac mirrored the American dream of the 1990s and early 2000s. Homeownership rates climbed, suburban sprawl expanded, and the myth of ever-rising home values took hold. Freddie's GSE status, backed implicitly by the U.S. Treasury, gave investors confidence that its mortgage-backed securities were safe, even when the underlying loans grew riskier. Lenders, eager for quick cash, began issuing loans with little documentation, no down payment, and adjustable rate terms that would reset to astronomical levels. Freddie Mac, chasing market share, bought these non-prime mortgages in ever greater quantities, believing its diversification and government backing would insulate it from loss. Warning signs flickered long before the 2008 crash. As early as 2005, internal auditors at Freddie Mac flagged a surge in subprime and Alt-A loan purchases. The company's own risk models warned that a broad decline in home prices could trigger massive defaults. Yet the appetite for higher yields outweighed prudence. By 2007, Freddie's exposure to adjustable-rate mortgages topped $300 billion, and the average credit score of its loan pool fell below 680, a stark departure from the prime borrowers it once championed. Meanwhile, housing price indices in key markets like Las Vegas, Phoenix, and Miami began to plateau, then dip, contradicting the endless-up narrative that had dominated Wall Street. The tipping point arrived in the summer of 2007, when mortgage delinquencies surged and the first wave of foreclosures hit the suburbs. Investors grew nervous, and the spread between Freddie's mortgage-backed securities and Treasury bonds widened dramatically. Credit rating agencies, previously generous with AAA designations, began to downgrade the GC as debt, signaling a loss of confidence. Freddie's stock, once a blue-chip favorite, became a roller coaster, shedding half its value in months. When Lehman Brothers collapsed in September 2008, the financial system teetered on the edge. On September 7, the Federal Housing Finance Agency placed Freddie Mac and its sister agency Fannie Mae into conservatorship, injecting $100 billion of taxpayer money into each to keep them afloat. The move was unprecedented. For the first time in history, the government seized control of a massive private sector financial institution to prevent a total market breakdown. Overnight, Freddie's securities, once deemed virtually risk-free, were repriced as junk, and mortgage rates spiked, choking the flow of new home loans. The aftermath reshaped the entire financial landscape. Home prices fell more than 30% from their peaks, wiping out trillions of dollars in household wealth. Unemployment rose sharply as construction halted and related industries collapsed. The Federal Reserve and Treasury introduced sweeping reforms, new capital requirements, stricter underwriting standards, and the Dodd-Frank Act to prevent a repeat of the GSE debacle. Freddie Mac, still under government control, was forced to shrink its portfolio, sell assets, and rebuild its capital base under tight oversight. Yet the legacy of Freddie Mac's collapse lingers. The conservatorship intended as a temporary fix has endured for over 15 years, with the GSE still operating under federal watch. Debates rage over whether to reform, privatize, or wind down the enterprise entirely. Meanwhile, the housing market has recovered, but the scars remain. Families who lost homes, investors who saw retirement savings evaporate, and a public trust in financial institutions that was profoundly shaken. Freddie Mac's story is a cautionary tale of how an institution created to promote stability can become a conduit for systemic risk when profit motives eclipse prudence. It reminds us that even the most powerful guarantees, government backing, credit ratings, market confidence, are not immune to the forces of unchecked speculation and poor oversight. As the nation continues to grapple with the lessons of the 2008 crisis, the shadow of Freddie Mac's rise and fall serves as both a warning and a beacon for reforms that strive to balance accessibility with accountability. The rise, the warning signs, the collapse, and the lingering aftermath of Freddie Mac illustrate a pivotal chapter in America's economic history, a chapter that still writes itself in policy debates, legal battles, and the everyday lives of homeowners across the country. Understanding this saga helps us recognize the fragile interplay between public policy and private finance, and why vigilance remains essential in safeguarding the dream of homeownership for future generations. Subscribe to The Collapse for more stories like this.